The most important time of day for the U.S. stock market may not be between the bells, rather outside trading hours. Big overnight moves could have big consequences for the next day's trade. Let's talk about that and more when we think about your portfolio and hear what this gap means for your money as Yahoo Finance markets and data editor and also host of Stocks in Translation, Jared Blikre. So Jared,
yes.
Translate all of this for me.
All right, gap. It's only 3 letters. We're going to break it down. It's pretty easy to understand once you see a picture worth 1,000 words. We'll get to that in a second. First, the definition. The gap is when a stock or other trading instrument, could be any security, could be a cryptocurrency, opens higher or lower than its prior close. And even if it doesn't close and there's continuous trading, you can still have gaps. Now, this has important ramifications for not only active traders and day traders, but also passive investors. And we'll get to some of those last. But first, we want to say that gaps tend to get filled. Not always. There's a saying that all gaps get filled. No, there are some Dow gaps from the 19-teens that have not been filled. I hope they never are. And then gap fills often lead to market reversals. And that's on an intraday basis. So let me give you an example of what happened last week in the S&P 500. I'm going to pull up a 5-day chart with daily bars here. You can see four bars here. Yesterday was a holiday, and we haven't had much going on these last 2 days. I want to focus on what happened last Wednesday to Thursday. So last Wednesday we closed right here, and then we opened up the next morning right here, slightly above that. And it's hard to see, but there's a little wick right here that says that the market went down there, touched this level almost precisely, and then it took off and closed much higher, right around 61.20. So going back to our example here, this has important ramifications also for passive investors, because as it turns out, one of the best times to be in the market is actually while everybody is sleeping. And let me just illustrate that by, we've broken down the market, this entire bull market going back to October of 22, and the different times of day have different results here. So 9:30 a.m. to 11:30 a.m. has resulted in some profits here, but not a lot. You can see it's basically been going sideways for the last 2 years. And then if we take a look at the 11:30 a.m. to 2 p.m., that has trended up and had some nice gains there. And then we take a look at the 2 p.m. to 4 p.m., that is barely positive. In fact, there was a nasty Fed day last month or 2 months ago in December that really brought this back down to zero. But I would highlight that 2 p.m. to 4 p.m. is supposed to be the smart money hour or 2 hours there. Just not the case this bull market. What has been a stalwart is the overnight market. And this has really taken off since about the second quarter of 2021. And you can see this highlighted here if I break down overnight versus regular trading hours. And the green here is regular trading hours, and the gap is overnight. And you can see this has just really trended up strongly since the beginning or first or second quarter of 2024. After a kind of false start here, we had a lower low in the beginning of this bull market. But as you can see with the green line really hasn't done much over the last year. In fact, you could easily say that it's been trending down. So if you were only in the market during the day, you were missing out on a lot of the gains that are happening in this market overnight. So while not all gaps fill, we do need to pay attention to it because it does have those ramifications for both short-term traders and the longer-term passive investors. Back to you.
All right, Jared, a really great breakdown. Thank you so much.